In today's episode, I'll talk about two very interesting stories. In the first story of the day, I'll talk about a scam that SEBI recently uncovered in the Indian stock markets. And in the second story of the day, I'll talk about how we in India are doing with respect to critical minerals, which could, in a way, form the future of our country. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Monday, the 6th of January. Now, before we begin, I have a very quick and small announcement to make. Now, I'm sure all of us at some point in time in our lives have been confused about so many jargons in and around finance and economics. And sometimes, honestly, it just feels like experts are just tossing around words to sound smart, right? And that is exactly why we thought of starting a new initiative called Stupid Questions. Very simply put, we want to make this a safe space for you to ask what you may think is a very stupid question. And our idea over here is to collect all questions and answer all of them together in the simplest possible language so that we can make finance and economics a lot more accessible and interesting to everyone out here. So if you are someone who has ever wondered what the meaning of a very commonly used word is, or you don't understand what the usage of it really means, this is a safe space for you to ask. We've attached a Google form in the description down below, and we'll try our best to answer all sorts of questions that make sense. Because our philosophy at Zerodha is very simple, there are no stupid questions as such, there are only honest ones. So with that thought, let's begin with the first story of the day. Now, a recent investigation by the SEBI uncovered a large front-running scam of about 65 crore rupees in the Indian stock market. Now, to everyone's surprise, it was led by none other than Ketan Parekh. Now, I know you've probably heard of him somewhere or the other. Back in 2001, he pulled off one of the biggest scams in India's stock market history. He's a former colleague of Harshad Mehta, and he ran up prices of the hot stocks of those times across industries like IT, media, telecom, etc., and then duped institutional investors into putting money into these stocks. Now, the amount involved in that fraud is estimated to be as high as 40,000 crore rupees. You heard that right, 40,000 crore rupees. Now, of course, back then, everyone from the SEBI to the CBI to the Serious Fraud Investigation Office went after this man. He was barred from the stock markets for 14 long years, and he also spent 3 years in jail. But the thing is, he's back now, and this time he has used a carefully planned network which involves insider information, counterparties, and profit making at every single step. So in this story today, I'll take a look at what this scam was, how it exactly worked, who was involved in it, and how SEBI put this puzzle together in order to solve the case. And like we always do, we will also understand how this affects the broader markets and also you and me as investors. But before we dive into the specifics here, it is important to understand the crux of this scam, which is front running. Now, for the sake of those who are new to the markets, front running is a type of market manipulation where someone uses confidential information about large pending trades in order to execute their own trades first. Now, for instance, if a large investor is about to buy a stock, its price is likely to rise for obvious reasons, right? Now, if someone has secret knowledge of this purchase beforehand, they can buy this stock in advance and sell it after the price goes up. Now, this way, he or she makes a quick and easy profit. And therefore, front running is illegal because it gives an unfair advantage to those people who have access to insider information and therefore damages the integrity of the stock markets as a whole. Now, back to the scam that I was talking about, there are 5 major parties in this scenario. Now, 3 of them are intentional and 2 of them did not even know that they were being used in this manner. The first party is Ketan Parekh himself. See, after being barred from the securities market for 14 years, he has re-emerged as the mastermind behind this new scam. He coordinated an elaborate network to profit from insider information, and he is the face of this scam, so to speak. The second party involved here is Rohit Salgaonkar. Now, he is a Singapore-based intermediary who worked to facilitate trades for big foreign clients in India. Now, because of the nature of his work, he had access to confidential trading details, and he supplied this very information to Ketan Parekh. The third party involved here is an anonymous big client. Now, this is a large US-based foreign portfolio investor who was placing massive stock trades in India. Now, these trades were absolutely legitimate, and they, in a way, unknowingly became the foundation of this scam. The fourth party are the front runners. Now, these were Ketan Parekh's associates and other people who acted on his instructions. These include brokers and corporate accounts who executed trades based on this insider information. And the fifth party involved here is the Indian brokers like Motilal Oswal and Nuvama Wealth Management. Now, these were the parties who facilitated the big clients' trades. And of course, they had legitimate agreements in place with Rohit Salgaonkar and they paid him a commission for bringing in the big clients' trades. But like the big client, they as well were unaware that their systems were being exploited for this scam. So now with that understanding in place, let's move on and take a look at how the scam exactly worked. See, this scam took a multi-layered approach which was designed to generate a profit at almost every single step. And let me take you through the entire thing part by part in very simple and easy words. The first part of the scam is the leakage of non-public information, which is also called NPI. Now, the big client I was talking about earlier relied on Indian brokers in order to execute their trades in India. Rohit Salgaonkar acted as its intermediary in the process. And as part of his role over here, Salgaonkar had access to a lot of critical details about the big client's trades. And these includes which stock they wanted to buy or sell, the quantity and the price ranges that they were looking at, and also what time these trades would take place. Now the thing is, instead of safeguarding this sensitive information, Salgaonkar started to share it with Ketan Parekh. And that brings me to the second layer of the scam, which was front running with this sensitive information. Look, once Ketan Parekh received this leaked information from Rohit Salgaonkar, he used it in order to execute trades before that anonymous big client could. And I'll tell you how this worked. In step 1, Ketan Parekh's network, which included brokers and corporate accounts, bought stocks that the big client was about to purchase, but just before the big client purchased them. And in step 2, when the big client's large orders came into the market and pushed up the stock price, Parekh's network sold their holdings and immediately pocketed the difference. And if that sounds even a little confusing to you, I will quickly explain this with an example as well. If suppose the big client planned to buy 1 lakh shares of a stock, Parekh's team would buy it first at say 100 rupees per share. Now when the big client's order came in, it pushed the price up to say about 105 rupees. And that is when Parekh's team immediately sold all their shares and made that 5 rupee per share in profit. And that brings me to the third layer of the scam, which is counterparties. Look, whenever you do something in the markets, someone else has to do the opposite. And what I mean by that is, say if you want to buy a share of Reliance, someone needs to sell a share of Reliance at the same time. And unless a stock is extremely liquid, the probability of you finding someone who is willing to do the opposite of what you want is very, very low. So for example, if you want to buy 10 lakh stock units of a relatively less liquid stock, it is very, very difficult to find sellers who are willing to sell such large quantities. And that is where counterparties come into the picture. Now, these could be individual traders or even institutions, and they are the ones who collectively agree to become the other side of the deal when it comes to extremely large orders. Also, intermediaries help to find counterparties so that their clients' trades can take place smoothly. Now, in the case of the scam that I'm talking about, Rohit Salgaonkar used a lot of Parekh's associates as counterparties to the big client's trades. And this means Ketan Parekh's team was directly involved in fulfilling the big client's orders. Basically, if the big client wanted to buy a stock, Parekh's network would sell it to them, which ensured they profited from the transaction as well in addition to everything else. And very similarly, if the big client wanted to sell a stock, Parekh's network would buy it because they knew that they could offload it later for a much higher price. Also, according to a statement by Rohit Salgaonkar to SEBI, about 90% of all the counterparties he facilitated were through Ketan Parekh's network itself. And that brings me to the fourth layer of the scam, which is the cash settlements via the Angadiya network. Look, I'm sure you can imagine running a scam is not easy. There is always a risk of getting caught, and therefore people explore different ways to keep their operation a secret. Now, in the case of this particular scam, Ketan Parekh used what is called the Angadiya network. Now, this is an old and informal system to move money or valuables between different places. It is very commonly used by jewelers and traders who trust Angadiyas to transport cash or precious items safely and quickly. And while this space is not strictly regulated, it has lasted for multiple generations because of the strong trust and personal relationships within this network. Now, using this network allowed Ketan Parekh to very quickly settle his profits with all of his associates, and he could also move money without leaving any trace in the entire banking system. So now that we all understand the basic pieces that are there in the story, let's move on and talk about how SEBI exactly uncovered this scam. Look, SEBI's investigation began when unusual trading patterns were spotted. The big clients' trades were consistently preceded by similar trades from other accounts, and that raised some suspicions. And I'll tell you how SEBI even put it together. See, they analyzed thousands of trades and found a very clear pattern. Parekh's network usually traded in the same stocks as the big client, but just minutes before the big client's orders were executed. Also, these trades were very highly profitable, and that suggested that this could be the case of access to insider information. So SEBI conducted search and seizure operations at 17 locations. They seized mobile phones and electronic devices and trading records and financial documents as well. SEBI also decoded WhatsApp chats and pseudonyms that were used to mask this scam. Now, Ketan Parekh used multiple phone numbers and nicknames like Jack and Boss in order to coordinate the entire scams. His WhatsApp chats showcased real-time instructions to his network about which trades to execute, and also it showcased evidence of his communication with Salgaonkar. So SEBI then linked all of these financial flows together. They traced the trail of money and uncovered cash movements via the Angadia network and profit sharing among Parekh's associates. The investigation is not complete, by the way. The matter is still in a preliminary stage, to say the least. But to safeguard the markets and maintain investor trust, SEBI took very quick action by passing a temporary order. Ketan Parekh, Rohit Salgaonkar, and other involved parties were immediately barred from trading. They were required to exit all existing derivative positions within the next 3 months. And like I said, in order to ensure that there are no missing links left, SEBI still continues to probe deeper to identify any more parties who are involved here. So all in all, if I were to summarize, this Ketan Parekh scam is a big reminder to us that some individuals can go to any length in order to exploit the financial system. While SEBI's vigilance exposed this particular operation this time around, it highlights the need for a constant oversight and accountability in the markets. Now, for investors like you and me, this case is a big lesson. While markets are definitely built on trust in a certain way, it is always worth questioning who might be operating behind the scenes. With that, let's move on to the second story of the day. The Indian government recently put up 21 different mining sites up for auction. Now, these sites hold minerals which are very important for our modern technologies. There are minerals like nickel, tungsten, copper, gold, and rare earth minerals. But what's interesting here is that most of these sites did not find enough interested buyers. 7 of them failed to get the legal minimum of 3 bids, and 4 of them got no bids at all. And as a result of that, the auction for these sites had to be cancelled altogether. Now, I know this might sound like a very dull piece of news for you at first, but the thing is, if you dig just a little deeper, you will see why this matters so much for India's future and as a result for you and me as investors. See, our world is changing very, very quickly. We are moving towards electric vehicles, renewable energy, advanced computer chips, and modern gadgets that run on high-tech batteries. Now, all of these, for obvious reasons, need certain minerals, which are also, by the way, called critical minerals. These include lithium, nickel, cobalt, rare earth elements, gallium, germanium, and a long list of other minerals. And to power tomorrow's technologies, we need to make sure that we have enough of these minerals today. Now, for a long time, people have compared oil to the blood that keeps the global economy running. And today, the growing belief is that these critical minerals will be just as important in the years ahead for us. Now, countries that have these minerals, or can refine them for that matter, will become very powerful, is the estimate. And this is similar to how countries with rich oil reserves hold a very strong position in world affairs right now. Currently speaking, China is completely dominant in the critical mineral race. They extract and process most of the world's supply. India, on the other hand, imports nearly everything from lithium to nickel, and we spend huge amounts of money buying these minerals from overseas countries. Now, because India is facing the risk of being left behind, we are trying to ramp up our efforts to find and mine our own deposits. Now, one key strategy over here is to auction off mining sites to companies, including international players, in the hope that they will extract these minerals at a large scale. But the thing is, recent auction results have been disappointing to say the least. Out of the 49 total sites we have auctioned so far, only 24 of them have gotten successful bids. And this suggests that miners do not feel it's worthwhile to invest in our country. So the question here is, why exactly is India not an attractive destination for mining companies? See, the first and probably biggest reason is that we ourselves have not explored these sites well enough before putting them up for auction. For business reasons, mining companies need to know the quality as well as the quantity of minerals in a site before they invest large sums of money. But the government has only carried out preliminary surveys on many of these sites, and there is no certainty around what can be found out there. Now, mining companies see this as a big gamble for obvious reasons. Nobody wants to spend many years and also a lot of money in the hope of finding something valuable, and that too only to eventually discover that the site does not have enough minerals to justify the cost in the first place, right? And that's not all. There is another issue: red tape and regulations. See, India has a lot of rules and paperwork around mining, including the requirement to secure many different clearances, environmental, state level, and many others as well. Now, mining is risky by nature. It takes vast sums of money to set up a mine in the first place, and returns for obvious reasons can take many decades to even be visible. Miners are also very unpopular in local communities because they can damage the environment and displace people. Also, unexpected political or legal challenges like a state government objecting to a project after the central government approves it can make things even harder for companies. And let me be honest, this is not just for India, these issues exist for any mine across the world. But if you add insufficient exploration and red tape on top of that, you can see why investors would pause before they would think of investing in India. But despite these setbacks, we have not quite given up as a country. Our government is making changes to mining laws and we are promoting the exploration of critical minerals now. We've joined international partnerships like the Mineral Security Partnership, which is led by the US in order to reduce our dependence on China. There is also willingness to invest more in research and data collection so that future auctions can give buyers a much more clear picture of what they are exactly bidding on. Now, India's challenge is to convince large mining companies that it is worth their while to invest in our country. And the main way to do that is by ensuring that our mining sites are explored more thoroughly, either by the government or by private parties, so that each site is not a complete mystery to the buyer. Streamlining regulations and reducing red tape could also help attract more companies, and these include those from other countries as well. Now, while the government's intentions are in the right place for sure, making these goals a reality is proving out to be a little difficult. Now, all of this points out to a crucial moment for India. If we do not figure out how to secure critical minerals for ourselves, we will always stay dependent on other countries for raw materials that power the technologies of the future. But if India does manage to solve these issues, which could be by improving our exploration methods, making smarter rules, or creating a stable environment for investors, we could very well become a real force in the global critical minerals market. So, in a manner of speaking, this is a race against time for us. As the world is demanding more electric vehicles, solar panels, and advanced electronics, the demand for critical minerals will only keep growing. India cannot afford to stand still and watch while other countries control these vital resources. Whether it is for energy security, economic opportunity, or just plain self-reliance, we must find a way to unearth these minerals and process them in a viable and sustainable manner. And that is why this space is very, very important for all of us as investors to keep a watch on. With that, let's move on to the final section of the day and talk about the quick news tidbits. First, Blinkit has launched a 10-minute ambulance service in selected areas of Gurugram by deploying 5 ambulances equipped with life-saving tools like oxygen cylinders, AEDs, and emergency medicines. CEO Albinder mentioned his plans to expand this service to other cities over the next 2 odd years. Now, this move marks Blinkit's diversification into healthcare, which enhances its social impact by addressing critical gaps in emergency medical access. Also, if you're curious, this service is bookable via the main Blinkit app itself, which further integrates essential services into its main platform. Second, India's sugar consumption for 2024-25 sugar year or SY is projected at 28 million tons, which is down 1.5 million tons from the previous year and is driven by the absence of election-linked demand. Domestic sales quota for the first 4 months of sugar year 24-25 is 0.7 million tons, which is lower as compared to the same period last year, according to the Indian Sugar and Bioenergy Manufacturers Association or ISMA. Sugar production in the first quarter of the current marketing year dropped 16% to 9.5 million tons as compared to 11.3 million tons a year ago, primarily due to a decline in Maharashtra. Third and the final one for the day, Coal India Limited reported a 2.2% year-on-year increase in production, reaching 543.4 million tons during April to December FY 2025 as compared to 531.9 million tons last year. December 2024 production rose by 0.7% year over year to 72.4 million tons, while coal offtake grew by 1.6% year on year to 561.2 million tons during the same 9-month period. Despite a production target of 838 million tons for FY 2025, CIL is likely to achieve 822 to 823 million tons due to challenges in land acquisition and environmental clearances, as noted by Chairman PM Prasad. Well, that's all the news and stories I have for you today. I hope you found value in this episode and maybe learned something new today. Also, like always, please do share your thoughts in the comments down below so we can have a conversation with you and improve this show accordingly. As usual, this is your host Anurag Bansal signing off. I will see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.